The realm of financial reporting hinges on the credibility bestowed upon it by independent auditors. These meticulous professionals shoulder the responsibility of scrutinizing an entity's financial statements and rendering an opinion on their fairness and accuracy. This opinion, the culmination of a rigorous audit process, provides stakeholders with assurance that the financial statements faithfully represent the organization's financial position, performance, and cash flows. This essay delves into the intricacies of audit opinion formulation, exploring the principles, standards, and procedures that guide auditors in their pursuit of delivering reliable audit opinions. At the heart of audit opinion formulation lies a deep understanding of auditing standards. These standards, established by authoritative bodies, serve as the bedrock upon which auditors base their judgments and decisions. They provide a framework for conducting audits, ensuring consistency, quality, and reliability in the audit process. A comparative analysis of global auditing standards, such as the generally accepted auditing standards, international standards on auditing, and public company accounting oversight board standards, reveals both convergence and divergence in auditing practices worldwide. While these standards share common objectives, their specific requirements and guidance may differ, reflecting the unique regulatory and legal environments in which they operate. The essence of auditing lies in the unwavering commitment of auditors to uphold fundamental principles that underpin their profession. Integrity, objectivity, and independence form the tripod upon which the credibility of the audit profession rests. Integrity demands that auditors conduct themselves with honesty, fairness, and transparency throughout the audit engagement. Objectivity mandates that auditors maintain an impartial mindset, free from bias or undue influence, allowing them to form judgments based solely on the evidence obtained. Independence, both in fact and appearance, is paramount to ensure that auditors act with skepticism and objectivity, without being beholden to the client or any other party. The journey of audit opinion formulation unfolds through a systematic process, meticulously designed to ensure that all aspects of the financial statements are thoroughly examined. This process, typically structured in phases, guides auditors in their quest to gather sufficient appropriate audit evidence to support their opinion. From the initial planning stages, where auditors develop an understanding of the client's business and assess risks, to the final stage of reporting their findings, each phase plays a crucial role in shaping the audit opinion. Understanding the interconnectivity and significance of each phase is paramount to appreciating the rigor and complexity of the audit process. Auditing standards serve as the compass guiding auditors in their pursuit of delivering high-quality audits. These standards, developed by authoritative bodies, establish a common framework for conducting audits, ensuring consistency, quality, and reliability in the audit process. A comparative analysis of prominent global auditing standards, namely GIS, ISA, and PCAOB standards, reveals both convergence and divergence in auditing practices worldwide. Generally accepted auditing standards, predominantly applicable in the United States, are issued by the American Institute of Certified Public Accountants. GIS provides a comprehensive framework for conducting audits of non-public entities, outlining the responsibilities of auditors, the performance of audit procedures, and the reporting requirements. International standards on auditing, issued by the International Auditing and Assurance Standards Board, aim to harmonize auditing practices globally. ISAs are widely adopted by countries around the world, promoting consistency and comparability in audit reporting. The Public Company Accounting Oversight Board, established by the Sarbanes-Oxley Act of 2002, sets auditing standards for audits of public companies listed on U.S. stock exchanges. PCAOB standards, while drawing upon GIS, introduce additional requirements and guidance specific to the audits of public companies, reflecting the increased scrutiny and regulatory oversight they face. Despite differences in their origin, scope, and specific requirements, these standards share a common goal: to enhance the quality and reliability of audits. The convergence of auditing standards is an ongoing process driven by factors such as globalization, cross-border capital flows, and the need for consistent, high-quality audits. International efforts to harmonize auditing standards aim to reduce complexity, enhance comparability, and foster investor confidence in global capital markets. However, divergence persists, Due to factors such as differences in legal and regulatory environments, cultural norms, and the maturity of auditing professions in different jurisdictions, the bedrock of the auditing profession rests upon a set of fundamental principles that guide auditors in their professional conduct and decision-making. These principles, enshrined in professional codes of ethics and auditing standards, serve as the compass for auditors, ensuring that they act with integrity, objectivity, and independence. Integrity, the cornerstone of any profession, demands that auditors conduct themselves with honesty, fairness, and transparency throughout the audit engagement. Auditors are entrusted with access to sensitive financial information and are expected to treat such information with the utmost confidentiality. They must be truthful in their communications with clients, regulators, and other stakeholders, avoiding any misrepresentation or omission of material facts. Objectivity mandates that auditors maintain an impartial mindset, free from bias or undue influence, allowing them to form judgments based solely on the evidence obtained. Independence, both in fact and appearance, is paramount to ensure that auditors act with skepticism and objectivity, without being beholden to the client or any other party. Independence, in fact, refers to the auditor's mental state, ensuring that their judgment is not compromised by any conflicts of interest. Independence in appearance relates to the perception of independence by external parties. Auditors must avoid any relationships or situations that could lead a reasonable observer to question their objectivity. These principles are not mutually exclusive, but rather intertwined, reinforcing each other to uphold the integrity and credibility of the audit profession. Upholding these principles is not merely a matter of compliance, but an ethical imperative. Auditors play a vital role in the financial reporting ecosystem, and their integrity, objectivity, and independence are essential to maintaining public trust in the profession. Failure to adhere to these principles can have severe consequences, eroding public confidence in financial reporting and undermining the stability of capital markets. The audit process, a systematic and iterative journey, guides auditors in their quest to gather sufficient appropriate audit evidence to support their opinion on the fairness of the financial statements. This process, typically structured in phases, ensures that all aspects of the financial statements are thoroughly examined, from the initial assessment of risks to the final communication of audit findings. The audit process generally comprises 5 interconnected phases: client acceptance and continuance, audit planning, risk assessment and response, audit evidence gathering and evaluation, and reporting. Client acceptance and continuance involve evaluating the client's integrity, the auditor's independence, and the audit firm's competence to perform the audit. Audit planning encompasses developing an overall audit strategy, setting the audit scope and objectives, and determining the timing of audit procedures. Risk assessment and response involve identifying and assessing the risks of material misstatement in the financial statements, both at the financial statement level and the assertion level. Auditors then design and perform audit procedures to respond to these assessed risks. Audit evidence gathering and evaluation involves selecting and performing audit procedures to obtain sufficient appropriate audit evidence to support the auditor's opinion. This evidence is then evaluated to form conclusions about the fairness of the financial statements. Reporting, the culmination of the audit process, involves communicating the auditor's findings to the client's management and those charged with governance. The audit report, a formal document, expresses the auditor's opinion on the fairness of the financial statements. The interconnectivity of these phases ensures a comprehensive and rigorous audit process. Each phase builds upon the preceding one, allowing auditors to refine their understanding of the client's business, assess risks, and gather evidence to support their conclusions.